Thank you very much. It's such a privilege to be here today and to speak to you, and especially to follow Professor Romer. He invited me to disagree, but there's nothing I can disagree with. It's really just very complimentary what I have to say. So I've been looking to come here to Da Nang, especially Da Nang, for quite some time. I first met the Da Nang delegation two and a half years ago at the World Economic Forum. And again, last year, I was so impressed with the Da Nang success story, the vision the delegation had for the city, that I've been meaning to come ever since. And well, here I am. Since then, actually, my roles have evolved, and we heard it in the introduction. I used to be the CEO of BlackRock Switzerland. Today, I'm the chair. I became the chair of SIFEM, the Swiss Development Finance Organization, and I joined the investment committee of British International Investment. So why do I say all that? I say that because I see the topic of investment and development from several perspectives. Development finance, institutional asset management, pension capital, and the practical discipline of investment committees is my background. And with this, I've sat on both sides of the table. Let me also clear what I'm not the expert on Vietnam. And there's a lot of people here in the room that know much better about this economy. I'm here as someone who has spent her career involved in how global investors think and move, and what that can mean for a country like Vietnam. And actually, this is a very fortunate week to speak here as a representative of the Swiss financial sector. A few days ago, the European Free Trade Association, the EFTA, of which Switzerland is a member along Norway, Iceland and Liechtenstein, concluded its free trade negotiations with Vietnam. And for those less familiar, Switzerland is in the EFTA, not the European Union. So this is really a big deal. It's a first milestone to the Swiss-Vietnamese economic cooperation. And it's a good moment to talk about capital. It's not that easy. So, let me tell you where I'm going so it's easier to follow. I will make 4 simple points. First, the financing challenge. The financing challenge, why this region needs far more green investment than public money can ever provide. Second, the blended finance response, how we use public money to bring in private money, and who those private investors are. Third, the scale gap, where this approach falls short and why. This is the honest part. And fourth, Vietnam's enabling conditions, what Vietnam can do to bring this capital in and to keep it. But first, a paradox. Vietnam is one of the great growth stories of our time. Growth of around 8% last year, a record year for foreign direct investment, and from this September, promotion to emerging market status in the FT Russell clarification, a signal that global index money will be coming. Capital, in other words, is flowing into this country at levels most economies can only dream of. And yet, the transition capital this region needs, the capital to build clean power and green infrastructure at the scale and speed the moment demands, is not flowing at anywhere near that pace yet. And that is the paradox. A country this attractive to capital still struggling to attract the right capital on the right returns. Answering why and what to do about it, this is what I'll be speaking about. Professor Romer made the case for why good rules Technology and innovation drive growth. I want to pick up from where this argument leaves off with the question that decides whether all that potential is ever realized. Where does capital come from and on what terms? Now let me size the problem honestly. What Southeast Asia needs to invest in clean energy is enormous, and it is rising steeply. On the International Energy Agency's numbers, the region needs to move forward towards something like $190 billion a year by the mid-2030s. That is several times today's levels. And yet, Southeast Asia accounts for only 2% of global clean energy investments. The need is here, the money so far is not. No public purse can close a gap of this size. Not Switzerland's, not the regions, not all the development banks combined. On the joint analysis of the IEA, the International Energy Agencies, and the International Finance Corporation, World Bank, for developing economies outside China, roughly 2/3 of clean energy finance will have to come from the private sector. Public money is the lever, yet it cannot be the load. So the real question is not how much money can we raise. It is how do we use public and patient capital intelligently enough to mobilize the private capital that already exists. The trillions sitting in pension funds, insurers, and asset managers who are not today investing here. Let me say a word about why it has to be green capital, not just capital, because it would be easy in a room focused on growth to treat green as a nice to have. It is not. Consider these four things. First, the lock-in. The infrastructure you finance today will be running in 30, 40, 50 years. I heard yesterday this hotel has been built 30 years ago, and here we are still today. Build the wrong thing now, at the moment of fastest growth, and you lock in the emissions and the stranded asset risk for a generation. Now think of your children. Second, the physical risk. Vietnam is at the most climate-exposed economies on Earth. Coastal, delta, exposed to typhoons. Infrastructure that ignores that risk quietly underwrites future losses. Again, think of your children. Third, the cost of capital. Transition-aligned assets increasingly attract a deeper, cheaper pool of global money. Misaligned assets face a shrinking and pricier one. Green alignment is becoming a financing advantage, not a constraint. And fourth, durability. A transition financed badly is economically and politically fragile. I will come to an example. The point is simple. The financing challenge and the climate challenge are not two problems. They are the same problem. Now, how do we mobilize private capital into places that it will never enter on its own? The instrument has a name, blended finance, and is worth being precise, because the term is used quite loosely. The OECD defines blended finance as a strategic use of development finance to mobilize additional finance towards sustainable development. In plain terms, a layer of public risk-tolerant capital, the very bottom, changes the risk and return profile of any project or fund, so that private investors will enter where otherwise they would not. That's the top layer. The public dollar is not here to fund the project outright. It is there to move far larger volumes of private money behind it. the kind of public money offered on easier terms than the market, we call it concessional or catalytic capital, and it sits at the very bottom of the capital stack. There is a useful way to think about what it does. Concessional capital does four things. It can protect against loss, a first layer of capital that takes the early losses of a project or a fund. It can raise the return, moving some of the profit so the commercial investor reaches the return it needs. It can also fix timing, reshaping when money comes back so it matches the investor needs, long-term liabilities, financing, for example. Or it can reduce volatility, a steadier result for an investor who cannot accept volatile returns. Each of those four answers address a specific concern that the specific investor has. And the honest measure of success is not how much public money you have spent, it is the mobilization ratio, how many private dollars each public dollar brought in behind it. Now, who are these investors? And what does each of them actually want? You cannot design the structure until you understand the appetites around the table. On the one side sits the development finance institutions like SIFEM, the one I represent, or British International Investments, or Proparca, the French development finance institution, DEG, the Germans, all active here in Vietnam. And the multilateral development banks, the Asian Development Bank, the World Bank Group, for example. Between us, we deploy a wide range of tools. We invest in equity, we invest in debt, in infrastructure, funds, projects. We lend to local banks. Some institutions do co-investments or invest directly in the projects. Some offer guarantees, and some provide concessional capital, money on easier terms, which takes first losses and brings other investors behind it. What we share is a purpose: to use public and patient capital to bring in private capital that would otherwise not come in. On the other side is the capital we're trying to attract. Each investor group has a different, very distinct, specific concern that decides whether it will invest or not. Insurance companies are limited, above all, by their capital rules under Solvency II. So they need a safe, investment-grade profile and steady, long-term payments to match their liabilities. Pension funds are bound by their duty to members, fiduciary duty. They need familiar, well-understood structures and, again, steady, long-term payments. Banks are governed by their own capital rules. They need safer, more senior positions. Sovereign wealth funds and family offices are more flexible. They really vary by mandate. The skill is to see which concern matters most for the investor you want and solve exactly for that one. No more public support should be provided than the problem actually needs. So let me be clear about where SIFEM, the Swiss Development Finance Organization, sits. SIFEM finances commercially viable companies through equity, debt and investment funds, and by lending to banks, including here in Vietnam. We are guided by the principle of additionality, simply called impact, development impact, and we mobilize private capital alongside our own. We invest through funds, not directly in projects or companies. And we are not the concessional first loss investor at the bottom of the stack. This role is played by others, usually the very large DFIs and MDBs, multilateral development banks. Our part is to invest professionally and to help to bring private money behind us. One last point about these institutions: we are often the first investor in a fund, the development finance organizations. And because we do the hard due diligence before we commit, our presence helps bring in others. Now let me talk about the single risk that, in my experience, kills more good emerging market infrastructure deals than any other. It is not political risk. It is not construction risk. It is the currency. Here is the mismatch. An infrastructure or power project earns its revenues in local currency. A Vietnamese offtake paid in dong. But its financing, especially international financing, is very often in hard currency, in US dollars. And when the local currency weakens, the cost of servicing that dollar, debt rises. Even if the project is performing perfectly well, generating every kilowatt hour as promised, the project works and the deal still fails. And that is where good projects die, quietly. Here's the part that matters most for this room. There is a crucial difference between international and domestic investors. A domestic investor, a local pension fund, for example, does not mind holding a local currency asset. Its own liabilities are in local currency. The two match. But the international investor, the deep global pool you most want to attract, almost always wants dollar exposure. It does not want to carry the currency risk. So the very capital you most need is the capital least willing to hold the risk at the heart of these projects. So what does the market do about it? Sometimes there is a natural hedge. Sometimes there is a natural hedge where the revenue is itself in hard currency, like an export terminal, port. But that does not remove the currency risk. It only shifts it, usually onto the buyer and the host economy. And sometimes it takes institutions built precisely to match that risk. Vehicles like the Currency Exchange Fund, TCX, set up by development-financed institutions and governments to take the currency risk and convert hard currency loans into local currency obligations. Switzerland helps to fund this work directly. Through SECO, the same part of the Swiss government that owns SIFEM, Switzerland is the third largest donor to the private infrastructure development group. Some $300 million invested on behalf of Switzerland since 2002. That group's guarantee arm, Garanco, exists precisely to provide the local currency solutions that infrastructure in Africa and in Asia needs. I raise this here in Vietnam on purpose because Vietnam is facing this exact question right now. When someone builds a power plant, they sign a long contract to sell its electricity, a power purchase agreement at an agreed price, the tariff. In Vietnam, those tariffs used to be dollar indexed. The price moved with the US dollar. This was a partial hedge. It protected a foreign investor when the local currency weakened. But these contracts still had well-documented problems with bankability, where the international banks were willing to actually lend against them. Now Vietnam is changing the framework. On the new direct power purchase agreements, the reforms that took effect this year, a private producer can sell directly to a company at the price the two of them negotiate. In several ways, that improves bankability. But the price is now negotiated in dong. So the underlying currency question remains, how is the international investor protected against the depreciation of the dong? These reforms on their own do not resolve it. And that is not criticism, it's simply the next piece of work, building the ability to finance in local currency and a stronger base of local investors, so that long-term money come in here and be repaid in the same currency as the project earns. And I do not want to leave you with this impression that this is all theory. This mechanism is real and it is inflecting in the region now. Globally, the numbers are still modest against the need. In 2024, official development finance mobilized around $75 billion of private finance, a record. set against a need across the developing world in the order of several $1 trillion a year. So you see the shape of the problem. The tool works, but the scale is not here yet. But look at Asia. Blended finance flows in East Asia and the Pacific roughly quadrupled in a single year, from around $1 billion in 2023 to around $4 billion in 2024, and strong rise in 2025. You're speaking, in other words, at the precise moment this region becomes the frontier of this work. And it is happening in Vietnam specifically. Let me give you a few examples from my own experience. The first is a fund called SIFEM, the Southeast Asia Clean Energy Fund. In its second vintage, managed by Klein Capital out of Singapore, it reached its maximum size of $175 million last year and is still rising. It is a textbook case of blended finance. It brings together development finance institutions, philanthropic capital, and the first private institutional money, and puts it to work here in Vietnam, in rooftop and distributed solar projects. Investors are many development finance organizations and MDBs. FMO, the Dutch development finance organization, Proparco, the French, Nordic institution, Swedfund, North Fund, and the Australian Development Investment Fund. International Finance Corporation, IFC, the World Bank Group, and the Asian Development Bank. The second example is newer and larger. In April this year, British International Investment launched British Climate Partners, a £1.1 billion initiative to mobilize private capital for the energy transition across coal-dependent Asian economies. Vietnam is explicitly among its named target markets. And there are others. Singapore has built one of the most ambitious programs, a program called FAST-P, anchored by the Monetary Authority of Singapore, the country's central bank. It brings together public, private, and philanthropic capital in three parts: one for green investments, one for industrial transformation, and one for the energy transition. The industrial transformation part is managed by BlackRock. I mention that deliberately because it shows where this is going. A global commercial asset manager, the world's largest, working inside a blended structure alongside development finance institutions and a central bank to bring private money into the transition. And BlackRock is not alone. Other large asset managers, such as Allianz Global Investors or TPG, are building similar blended vehicles for emerging markets. The point is not any one fund. The point is that this is now a category. Serious commercial asset managers, alongside development institutions, building blended structures aimed exactly at this region. And this is not only about big infrastructure. Private capital is already flowing into Vietnamese climate ventures. Climate tech funding here has reached new highs last year. In companies you might know, like Alterno, That Bike, and Stride. One of them, Stride, sits in the very fund I mentioned earlier, SIFEM. Now, this is the part I want you to hear from me. I'm the development finance person here in the room. It would be easy to tell you only the good news. I will not. Blended finance has not scaled the way its advocates hoped. The OECD, the body that defines the field, says so plainly. It states that blended finance has mobilized relatively limited private finance so far, and that it has remained a cottage industry, bespoke and fragmented. In the collective investment vehicles the OECD surveyed, private commercial investors contributed less than 6% of the total capital. It's virtually nothing, despite the entire purpose of mobilizing them. The IFC has found that a large part of the blended finance the institution does deploy goes into senior debt, among the least effective positions for mobilizing private dollars. which suggests we, the public institutions, too often take the safe senior seat instead of the risk-absorbing junior position, one that our mandates call for. And the money is not reaching the places that it needs it most. Only 5% of the world's financial assets are invested in developing countries outside China. And only a sliver of that reaches the least developed countries, nearly 1 billion people. There is a cautionary example close to home. Vietnam's own Just Energy Transition Partnership, the $15.5 billion pledged at the end of 2022, has been widely reported as slow to disburse, with much of it offered at market rate loans rather than grants. I raise this not to criticize, but because it makes the point precisely. A pledge is not a disbursement, and finance offered at the wrong terms may not be finance that arrives at all. I say this not to talk down the instrument of blended finance. I believe in it, otherwise I wouldn't be doing this work. But the credibility of the whole effort depends on being honest about where it also falls short. For a development finance institution, that honesty, we call it additionality or impact in plain terms, is everything. It means only financing what the market truly wouldn't finance on its own. Not stepping in where private money would have come in anyway, and not overstating how much private capital we have brought in. If we claim credit for what we have not earned, the whole idea loses its meaning. So what would change this? The OECD's own answer in its recent guidance actually calls it not more money, but rather standardization. Today, too many of these deals are built one at a time, bespoke and slow. If instead the structures were simpler and repeatable, standardized guarantees, structured funds, securitization, the products institutional investors already understand, they could be replicated at scale. And the cost and time of each deal would fall. Just think of the success of ETFs, a world I know well. And the concessional capital at the center should be used sparingly and temporarily, just enough to prove a market works and then step back and let commercial money come in. Simplicity, repeatability, and public money that knows when to withdraw. That is how this moves from a cottage industry to something that matters at scale. Now we come to my last slide, enabling conditions for capital mobilization. We're turning from mechanism to you here in the room, to what a country and a city need to do to bring this capital in and to keep it. From the practitioner seat, it's 4 things that decide whether the promise of money ever becomes money to be paid out. First, it's policy predictability, especially stable, credible frameworks in the power sector. International investors prize predictability above almost everything. Second, depth in local currency, the ability to finance and to hedge in the currencies that revenues are earned in. Third, a real bankable pipeline of projects, more often the binding constraint than the availability of capital. And fourth, credible exit pathways. And this last point brings me to your capital markets. Vietnam's public market is growing fast, and the coming FTSE Russell upgrade is a real turning point for foreign institutional money, believe me. But for the patient, long-term, private capital I have described, the honest question is about exits. How an investor eventually gets its money back out. The stock market is just one route, a public listed. And here the picture is improving, though it is still a market dominated by smaller retail investors trading on a short horizon. So its depth is real, but very shallow. Last year's headline gain, you would all know this here in the room, the index was up by more than 40%, was driven largely by a handful of stocks, most of them tied to a single conglomerate. A market that moves on a few names is not yet the deep, broad market long-term investor needs. Yet the public listing is only one way out. Private capital also exits by selling to a strategic buyer or to another investor. And all of these depend on the same thing: a deep enough pool of buyers and markets mature enough to absorb a sale with confidence. Building that depth, a broader base of local institutional investors and the capacity to finance in local currency is what would let long-term capital enter here and leave with confidence. I would say the same gently about the ambition many of you hold for Da Nang, the International Financial Center, the Silicon Beach. I'm very supportive and impressed with what I've heard so far and keen to hear even more over the next couple of days. But a financial center is only ever as real as the deals it can actually clear. It is not the designation that makes a market, it's the infrastructure of trust beneath it. Disclosure, enforcement, dispute resolution, currency depth. Build that and the capital will come. Let me end where I began, with a paradox. Vietnam has already proven it can attract money. That question is settled. The next test, the harder one, is whether it can attract the right capital, patient, long-term, climate-aligned capital, on terms that serve a transition that is both just and durable. My message to the policymakers in this room is simple and optimistic. Build the pipeline and the predictability, deepen your institutional base and your capacity in your own currency. Do that, and the blended structures, the development finance institutions, and the private capital behind them, we will meet you there. That is what we exist to do, and the time is now. Switzerland has been invested in this country and this work for the better part of 2 decades, quietly through funds and in the real economy. We intend to be here for the next 2 decades at least, and I hope for what this week's agreement between our countries makes possible. Thank you.
Thank you, Dr. Staub-Bisang, for your valuable perspectives.